It is without a doubt in our mind that everyone in this classroom has heard of these four accounting terms: T accounts, debits, credits, and trial balances. These terms are thrown at us very frequently in accounting class, like how Bradley frequently takes dodgeballs at the face during gym class. However, the Christmas holidays have probably turned all of us into lolloping gravy balloons, and it is likely we've all forgotten what each of these terms means. Luckily, Matthew and I have produced this informative video to refresh everyone's memory. Without further ado, let's get started. Now, let's discuss T accounts, shall we? No, not the wrestler. First off, to understand T accounts, you must first understand what an account is. An account is a record of each change of the accounting equation. A T account is simply a way of representing individual accounts. A T account is named because of the T shape of each account. Allow us to demonstrate how T accounts work. Please observe the screen. There should be three T accounts. The first T account, cash, is an asset. The second T account, accounts payable to Bradley Zhang, is a liability. The third T account, Yong, represents owner's equity. We are now going to put the starting sums in each of these accounts. Notice the starting sum for the asset is placed on the left, while the starting sums for the liability and equity are placed on the right. Now, suppose you pay $1,000 to B. Zhang to sell your account payable with him. However, he also charges you $20 in interest. The cash will go down $1,020, and the accounts payable to Bradley Zhang will be gone. However, your owner's equity also decreases by $20, since the equation wouldn't balance otherwise. Notice that the deductions to assets take place on the right, while deductions to liabilities and equity are on the left. Now suppose that M. Yong puts $1,000 into his business. In this case, the cash would increase by $1,000, while owner's equity would also increase by $1,000. Notice that additions to the assets take place on the left, while additions to the liabilities take place on the right. This is all part of a system that will be talked about later.
By later, I mean right now. It's time to learn about debits and credits. To start with, you should know that debits refer to the left side of a T account, while credit refers to the right side of a T account. The abbreviation for debit is DR, while the abbreviation for credit is CR. When the value of an asset increases, you add to the debit or left side of an account. Vice versa, if the value of an asset decreases, you add a value to the credit side of an account. This reverses for liabilities and owner's equity. The value of a liability or equity increasing means that value is added to the credit side of an account, while decreases in liability or equity result in changes on the left side of an account. In accounting, the double entry system is always used. This is to say that debits are recorded first, and then credits are recorded next, hence the double entry. It has to be made sure that debits are equal to the credits as well. If this is not true, then your entry is incorrect.
Keep in mind that sometimes accounts that should be credits end up as debits, or vice versa. This is not always a mistake. For example, say that we have $50 in our bank account. Suppose that we now give a check to a customer for $60. We don't have enough money in our bank for that. However, some banks have something called overdraft protection, which allows your bank to dip below zero. If this happens, however, our bank account turns from a debit to a credit. This is just one example of an exceptional account balance.
Lastly, we're going to cover trial balances. If you recall from past accounting classes, the sums of the assets and that of the liabilities and owner's equity in the balance sheet must be equal. The same goes for ledgers. The debits in a ledger must be equal to the credits. This is the purpose of a trial balance, to ensure that the debits and credits in a ledger are in balance, or equal to each other. If the debits do not equal the credits, the ledger is said to be out of balance. And then you must look through the debits and credits to find out why this is. Now, we are going to show you an example of a trial balance. The process of making a trial balance is referred to as taking off a trial balance. You can see here that the debits are put in one side of the chart, while the credits are put in the other. Remember that assets are debits and liabilities and owner's equity are credits. Look at the bottom. You can see that the sums of the debits and credits are equal, like they are supposed to be. This is a quick example of a trial balance. Thanks for listening to us. We hope you enjoyed our presentation.